Welcome, everyone. My name is Nikki Johnston, and I'm with Transition Advisors. Our webinar today is Internal Succession, the 5 steps to making it work in your firm. Before we begin, we need to cover a few important items. First, please close any other programs that you have running on your computer. This will help ensure quality presentation and reduce any audio issues. Transition Advisors, LLC, is a proud and approved sponsor on the National Registry of CPA Sponsors per NASBA. In order for you to receive your 1 CPE credit for today's webinar, you must complete 2 requirements. The first is that you must participate in all 3 of the polling questions that we'll have throughout today's presentation. Next, you will receive a link to an evaluation. I'll email that to you later this afternoon, and you must complete that online evaluation in order for us to send you your CPE certificate. Once both of those requirements are met, the certificate will be emailed to you, and you'll receive that within 10 business days. There will be an additional, very brief survey for the webinar that will appear immediately after the session ends. So if you could take just a moment to complete that, that survey is important to us as it helps us provide you with quality information. So in order to fully participate in the webinar today, please take a moment to familiarize yourself with the GoToWebinar control panel. It should be on the right-hand side of your screen. There's an orange arrow at the top, and that'll be used to minimize the control panel. Throughout the presentation, all the participants will be muted, but you can communicate with us by using the question box, which is toward the bottom of your control panel. Just type your question there and click Send. Questions are very important to us, and Terry will be answering your questions throughout today. Finally, I'd like to remind you that we offer a free 1-hour CPE webinar each month. Our upcoming topics include avoiding merger roadblocks, understanding what your partnership agreement should include, and tax season implications for M&A of accounting firms. You can view a complete list of all the webinars, including links to register for them, at the CPE courses section of transitionadvisors.com. Finally, in the survey that will appear immediately following today's webinar, you'll have an opportunity to request a hard copy of today's presentation if you'd like. You can also email me directly. My email address is on the screen right now. And I've also just sent a chat to everyone that has a link to where you can download those slides from our website now if you'd like to follow along with Terry. So with all of that said, I'd like to introduce our presenter for today's session. Terry Putney is the CEO of Transition Advisors. We thank you for joining us and hope that you enjoy the webinar.
Welcome, everybody. One thing I wanted to also remind you is there is a recording of this webinar there will be on our website. And if you have anybody that you'd like, you suggest would listen to the webinar, maybe somebody else in your firm or another colleague in another firm that you think might find it interesting, you can direct them to our website, to the CPE section, and they wouldn't be able to get CPE, but they can listen to the webinar as the same as you have been able to. Just a quick introduction to our firm, if you're not familiar with us. We are strictly involved with ownership transition issues with CPA firms on a national basis. That kind of breaks into 3 areas. One is a lot of the work we do is involved with mergers and acquisitions, and we support the complete process from production all the way through to the, which means that we do searches for firms. We trying to find a merger partner, make the introductions, help with the negotiations, structure the deal, can help with actually the contract design and review and valuing the firm and so forth. And the other practice management issues we're involved with, again, involve ownership transition. We do a lot of work with partnership agreements, reviewing partnership agreements to see if they're still valid, if they relative to the firm's circumstances, looking at compensation plans in the agreements, succession planning, helping firms assess whether or not they're able to actually carry out an internal succession, and that is the subject that we'll be addressing today. Just a quick introduction again to the rest of the people in our firm. In addition to myself, Joel Sinkin, who many of you may have heard on other webinars, is president of our firm. Bill Carlino is the former editor-in-chief of Accounting Today and joined us a couple years ago and manages our national consulting services. And then the other consultants that work with us in the firm are Mark Bazinski, Russ Bess, Nancy Egan, Peggy Tyers, who manages Canada for us, Marcia Miller, Mike Farinelli and Kay Conklin. What we're going to talk about today is it's not rocket science. I'm probably not going to say anything that you haven't heard before. None of this is that. Most of this is pretty rational and logical. So why is it that most firms struggle with this issue? Why is it such a big problem for the profession? Well, I think the reason for that is that the issues around succession are mostly emotional. They're the things that keep people from making decisions are emotional decisions. This is a decision that typically you make once in your lifetime, and that's a decision to how you're going to end your professional career. And as a result, it's difficult for people to make the decision. It's not something they've done before. So they tend to kind of lose their normal logical way of thinking as an accountant and kind of struggle with what to do next. So what we're going to try to go through here is how to create a disciplined approach to evaluating the decisions that you need to make for yourself and in your firm so that you can make a more logical decision of what you need to do. One of the best sources for information about what's happening in the profession with regards to succession issues is the 2012 and the 2008 PCPS Succession Survey. If you are a member of the PCPS division of the AICPA, and you haven't seen the survey, I recommend that you obtain it. It has a lot of valuable information in it. Another source, a good source for information regarding succession issues, particularly as it relates to partner agreements and how firms are dealing with that issue in their agreements, is the Rosenberg MAP survey. I also recommend that. In those surveys, we found that 95% of the firms that responded to the PCPS survey expect that a partner succession will be a challenge in their firm in the next 10 years. And almost 80% of those firms expect that this is going to be a significant issue, meaning probably that it could threaten the future of the firm. Part of the reason for that is that we're an aging profession. This data is not unique to the accounting profession. There are 77 million baby boomers in the United States, and the next generation that we're going to leave, what we've built to, is the next generation, and that's about 50 million people. So there's a significant shortage of people to replace those of us that have built businesses. And it's not just in the accounting profession. But in the 2008 survey, and this data was not actually asked in the 2012 PCPS survey, 65% of sole proprietors are 55 years of age and older. Now, that's a good indication of the age of most of the partners in CPA firms as well. 63% of partners of multi-partner firms will have at least one owner retire in 5 years. Now, remember, this was in 2008, so this data has probably only gotten worse since then. And the average size of the firms that responded was about 4 partners. So you're seeing that at least 25% of the partner group is going to leave in the next 5 years. Almost a third of the firms that were multi-partner firms said that they would have at least 2 owners retire in the next 5 years. So needless to say, in those firms, that's a significant issue. One of the challenges that we face as a firm that is going to be seeing partners leave, who's going to take over, and unfortunately, many of the firms, almost half of the firms that responded, felt like the younger members of their firm were not ready to step into leadership roles, meaning we don't have anybody to take over. What's going to happen? Make matters even worse, in the last couple of years, 5 years ago, we were going through a tremendous economic calamity in the United States, and as a result, unemployment became significant. There was a lot of excess labor available. There's an ability to hire people at a low cost. Most employees were concerned about their ability to keep their job, and so they weren't really clamoring for more compensation. They were happy to stay where they were. What we're finding now, of course, is things have flipped, and this has been a significant flip within the accounting profession. The estimate right now is that the unemployment rate in the accounting profession is about 3.5%. Well, if you remember, from your days in macroeconomics, 3.5% is actually considered below full employment. There normally is at least that many people. 5% is considered full employment, meaning that about 5% of people are generally in between jobs for some good reason. other than a lack of employment. So what we're seeing amongst our client base, at least, is in the last, I'd say within the last 6 months, a significant concern about their ability to attract new talent to their firm, which of course feeds into more succession challenges. With that, we're going to start off with our first polling question. Nikki, I'll let you launch that.
Sure. Our first polling question today is about the percentage of the partners in your firm that will retire in the next 5 years. So take a moment to indicate your answer there. You see the choices in front of you. We'll keep it open for about 30 seconds to give everyone a chance to answer. And just keep in mind that you do have to do the polls in order to receive the CPE credit. Okay, I'll go ahead and close the poll now and show the results. And then I'll turn it back to you, Terry.
How do we get to those results, Nikki? I didn't see.
Oh, I'm sorry, Terry. Were you not able to see them on your screen?
It looks like
the biggest percentage from the group, 29% of our attendees said that 0% of their partners would be retiring. The next most popular answers were 11 to 25% or more than 50%. Those are both tied at 24% of our respondents.
Okay. Obviously, more than 50% means a significant turnover within your firm and can create a lot of stress within the firm. Hopefully you've got people, those that answered that way, you've got people ready to take over. And we'll talk about how to do that here later in this presentation. You know, the problems that we tend to see amongst the firms that we work with, specific problems relating to succession are that you know, first, their bench strength is not strong enough. And what's meant by that is they just don't have enough good clay. They don't have people that have the kind of talent that they believe will eventually turn into partner material. They just haven't hired the right kind of people. And, you know, this is a problem that a lot of firms have because they hire for short-term need. I mean, you hire somebody that can, you know, get a tax return done accurately and fast. You don't think about what else they need to be able to do, you know, grow into down the road. And many firms have found themselves, you know, hiring for these short-term needs over the years, and all of a sudden the time comes for them they need a partner in the firm, and they've never hired somebody that could possibly have that talent. The next issue is people that have the talent, they've got good, strong people, but they're just not developed. Haven't been around long enough, or the firm hasn't focused on the development of those people into leaders, potential leaders in their firm. We run into a lot of firms that have somebody who's ready. They've been ready for several years. They don't know how to add them in, how to bring them in as a partner. A lot of times this happens in firms that came together with all the partners had existing books of business, and they formed their firm, or maybe they formed their firm years ago and have never admitted a new partner and really don't have an agreement or a financial means bringing a new partner in and need some guidance. And then finally, a really large challenge for a lot of firms is that the owner agreement they have in place, they believe it will not work when it comes to buying out retiring partners. Oftentimes, the agreement might be too rich, or the partners who are going to be left behind are not comfortable that they'll be able to afford it for whatever reason. They just never thought it through and thought, gee, how's this going to work? Needless to say, we provide that service to firms, and you know, for instance, if you wanted an evaluation of your partner agreement to see how it was going to work, that is a service that we offer. The process of going through internal succession and evaluating your readiness is a 5-step process. The first thing that you want to do is assess your readiness to address succession. You know, what is the need within your firm? And we'll go through how to do that here in a second. Second is, you know, making sure you've got the right talent, making sure you've got the right clay in place. The third step is, you know, the development process of that talent in successors, and that's not specifically what we do as a firm, as a consulting firm, but it is something we can help you understand what you need to do. The fourth is, of course, having the proper financial arrangement in place. Your owner agreement works for bringing new partners in and bringing and buying other retiring partners out. And then finally, making sure you've got a proper transition plan for the duties of partners who are leaving the firm. You know, the two issues to focus on when you're dealing with assessing your readiness is the timing of when partners are going to be leaving and how you're going to replace those partners. You first need to know how acute the problem is that you're going to have. So in looking at the replaceability, there are two different ways that partners get their duties are replaced. One is a role reallocation, and we'll talk about what that means in a second here. And the second is a role succession. In a role reallocation, you are allocating the duties of that partner to the other partners in the firm, and you don't really feel like you have a need to bring a new partner in to replace them. In a role succession, you don't have the capacity or you don't have the skill set necessary in your firm to replace a partner that's going to leave, and you're going to have to find a new body. So looking at role reallocation, where you might be able to pull this off is if you have sufficient capacity. So just to give you an example, say you're a $3 million firm and you've got 4 partners. Each of those partners, one of those partners is going to leave, and and the other 3 partners feel like, you know what, I can manage a $1 million book of business or even more. I've got capacity. I know some of these clients, many of these clients of this retiring partner. I feel like I can take over those responsibilities. There really isn't a need for us to admit a new partner. Now, of course, you can't do that forever, but with respect to that one partner, that first partner that might be leaving, the partner group feels like they have the capacity to take that on without adding another body, at least immediately. This also might be the case where you have partners that don't have any specific skills that need to be replaced, that there's nothing special about their duties, their administrative duties, and so forth. A role succession, on the other hand, is a scenario where you just don't have the capacity. I run into this a lot of times where I'll be talking to a firm and they'll say, gee, we need a new partnership agreement. The one we have isn't going to work, and so-and-so is going to leave after this next tax season. And I'll look around and say, okay, who's going to take over so-and-so's book of business? Well, they've never actually had this conversation, but as they have the conversation, they realize that nobody really feels like they can do it. So there isn't the capacity to actually create succession within the firm because none of the existing partners feel like they can take over those duties, and they don't have anybody in mind to bring in as a new partner. It's amazing how often I actually have this kind of conversation. It seems so obvious that they would have had it before then. But in a role succession, you need to add a body. So the key to this now is understanding how to do that and when to do it. Another example, of course, is if you've got special skills. Somebody has a certain, maybe as a wealth management person, and they have licenses that need to be replaced, or somebody is a business valuation expert, and we need to replace that skill set. Generally, when you think about this, you need to think ahead and understand the transition process. We'll get into that a little more later in this presentation. But a transition generally is going to take at least 2 years. Ideally, it would take even longer. And you want to make sure that during that 2-year period, you've got the active involvement of a transitioning partner. So you need to have, what we're getting at here is you need to have in place the person that's going to take over the responsibilities for this exiting partner in time for there to be this 2-year active involvement of the transition of the partner's duties and the client relationships. Now, oftentimes we're not talking about one person replacing one person. We're oftentimes talking about spreading that responsibility around the firm. So there's a transition that's often happening amongst many partners. But you've got to, in most cases, you need to give yourself at least 2 years for this process to play through. Most clients are only seen annually, so 2 years is only 2 visits. So when you think about it, if you're going to have an active involvement in the process of transitioning a client base, 2 years gives you really the minimum amount of time you need to get this done. The idea here is to make sure that the day that the partner retires, and oftentimes they don't retire completely, but they stay on in a part-time role, but you have to assume they might retire completely, that day is a non-event for the clients and the staff because they've already made the transition to their new relationship in the firm. So going through the process of evaluating your situation, this is a handy little tool that you can use. And in this case, we have 5 partners. The first partner who's going to leave is going to leave within the next 3 years, and we feel like we don't need to replace that partner with another body. So that's a role reallocation, and obviously we have the capacity in place. All we need to do is start the transition at the right time to the people that will be taking over. In this example, we have 2 partners, though, within the next 4 to 7 years that require role succession. Now, part of that's probably going to be because they will have taken over some of the responsibilities of the partner leaving first, but also they may have some special skills and so forth. So what that tells us is that we need to have in place their replacements, 2 new partners at a minimum, within the next 2 to 5 years in order to make the transition work. And then in this example, the other 2 partners are more than 8 years out. Maybe we don't need to worry about them quite yet. But if there's going to be if it's a very difficult process of finding their replacement, then we need to think about that as well. So what you're doing is you're projecting, in this case, where your succession needs, what kind of succession needs you have, and when you're going to need them. That'll take us to our next polling question, Nikki.
All right, for our second polling question today, again, we're answering how this applies in your case. So the statement is, our firm has the necessary talent on the bench to replace the partners that will retire in the next 5 years. And you can indicate either yes, no, or not sure. I'll leave it open for just a few more seconds. So if you haven't yet cast your vote, please do so. Just remember, you have to do the polls for the CPE credit. Okay, I've closed the poll, and here are the results. Looks like 44% of our attendees indicated yes, 33% no, and 23% not sure.
Okay, it's actually better results than what I expected. We have a strong group on the line with us today. So the 44% that feel confident they've got the talent on board, congratulations. And for those of you that aren't sure or that know you don't, let's talk for a minute about how to fix that problem. You know, your first step, and again, none of this is rocket science, is obtaining the necessary talent that you need. There's really 3 ways to do that. One is, you know, the ongoing normal recruiting that you do in your firm of inexperienced talent. You know, maybe you hire people from college, maybe you like to hire people that have a year or 2 experience at another firm, but they're people that are, quite frankly, a long ways away from being partner material, but we need to talk about how to do a better job of hiring those people so that in the, you know, 8 to 10 years or 12 years or whatever you think it takes to be a partner in your firm, they're going to be the right people that are going to be ready when you need them. If you're in a more acute situation, let's go back and remember the polling question was, do you have the talent in place to replace people in the next 5 years? You don't really have time in that case, of course, to hire somebody out of college to become, you know, a replacement for a retiring partner. In that case, you need to be hiring people that are closer to, that already are developed, they're near partner or they're already at partner level, and we're bringing in more of an instant answer. And then the third approach, of course, is potentially to use a merger or an acquisition to obtain the talent necessary to replace your partners when they are ready to leave. It's a harder thing to do. It's amazing how many firms are out there trying to do that. There's a limited pool of available opportunities, but it can work, and we'll talk about how to make that work. When you're hiring low experienced talent, I think that, as I said before, one of the problems I see, and when I was managing a CPA firm in the Midwest here, we were definitely guilty of this, of hiring people for a short-term need that definitely didn't have any long-term potential. And I think that's, you know, you wake up one day and you realize, I just don't have the right people around. I've made a mistake in all the hiring that I've done here over the years. So in order to correct that, I think what helps is to build a benchmark or a goal for what the attributes a person has to have to be a partner in your firm. And, you know, most of us have this, knowledge intuitively. The problem is that we don't, we haven't written it down, it's not complete, and we don't have an agreement within the partner group as to what those attributes are. So the time comes for us to make a decision about somebody, and we're doing it off the cuff. So we'll, I'll be facilitating a partner retreat for a firm, and we'll be talking about the people that are on board and whether or not they're ready, and we'll go around the room, and about, let's say there's 6 people in the room. 3 people will say, well, Sally's definitely ready, I think we should go ahead and do it, and 3 people will say, no, she's not ready, I won't agree to admit her as a partner. And they really don't have, the kind of conversation that leads from that is one that's pretty much just off the cuff. Well, I don't think she can do this, or I don't think she can do that, or we really don't have any alternative here, we have to do it. Instead, if we had this benchmark, if we had this predetermined list of attributes to compare Sally's performance against, not only would we be making a better decision at that time, but we probably would have been engaging in a much better development process with Sally over the years as we evaluated her against that benchmark. So here's just an example. I actually got this this is a composite of job descriptions, and I hate to call them that because it's really more than that, for partners in many firms that we've worked with. Just an example of the attributes of a partner in the CPA firm. So if we're using this as an evaluation tool, then we can do a better job of determining when people are ready and how to develop them. When you're hiring a near partner talent person, keep in mind that the people you're trying to attract are successful. They're already in positions where they're successful, and they have other alternatives. What you're trying to become is a better alternative for them. I'll give you an example of a situation like this. I was working with a firm, 3-partner firm, with a very acute succession need, very successful firm. This was actually, they do about $6 million in volume, which is pretty high for a 3-partner firm, very profitable. And but we had 2 partners that were going to leave in the next 5 years. So the problem was going to be extremely acute, where the chances were, unless we did something very dramatic, we were going to have to probably merge the firm upstream into another firm. And I asked them, I said, what options do you have here? Well, it turns out that they were out recruiting in the marketplace for experienced talent, and they actually had identified somebody who was a very good candidate that was at a much larger firm. So I asked them, well, what's keeping you from doing the hiring? Well, he's going to be very expensive. I said, well, tell me about that. And they said, well, I think it's going to cost us about $200,000 a year to hire this person, and we're concerned that he isn't bringing a book of business, and I don't know if we can afford to do it. I said, I don't know how you can afford not to do it. I said, if the person's actually what you think he is, then if he will build his own value within the firm within the first year. You might take a step back for a short period of time, but within the first year, either he's the right person and you're not even going to notice this, or he's not the right person, in which case, you're going to have to, cut bait. But either way, the point is that you've got to be aggressive in this area if you're going to attract the right people. One of the other things that you need to make sure that they understand is if you're hiring them to become a partner in the firm, there should be a pretty good understanding of what it's going to take to be a partner in your firm. Now, it's very rare that you would hire somebody without a book of business and make them a partner immediately. But normally, if they're not on a 2 or 3 year program that you can describe in pretty clear terms, then it's going to be difficult to probably attract the right talent. So that means explaining what steps need to be necessary in terms of their development, what do they have to demonstrate, what skills do they have to demonstrate, and what's the financial arrangement going to look like when the time comes, and what's the financial upside for them as a partner in your firm. If you need to be able to have that kind of conversation to attract the right people. When you're looking at doing this through mergers, keep in mind that, most firms that are seeking a merger have succession issues. I'd say that of the ones we work on, maybe 95% of them have a significant succession need, is what's driven the firm to seek an upstream merger. So you're going to be taking on somebody else's succession problem at the same time you're trying to solve your own, and that may be a reason not to engage in this tactic as a way to get talent. But if you can find it, what you're looking for is a firm that has what I call a diamond in the rough, somebody that's got strong potential, but for one reason or another that hasn't been developed into a partner level person, or a person that's got, or a firm that has young partners who have just been admitted and can present for you a good opportunity for your long-term succession need. But these are hard to find. I mean, it's I can't tell you how many times I've been told, please go find me that, and I'll say, okay, you and 25 other firms have asked me that question in the last 2 weeks. Once you've got your talent on board, now the question is, how do we develop it? And go back to your job description, make your assessment of where the gaps in their performance are relative to the job description, and then train towards overcoming those gaps. Don't be afraid to cut bait and fish elsewhere. I see a lot of firms that have somebody that's a key person, very productive, has a lot of client following, but can never be a partner in the firm, but they're in the way of other people developing and getting past them. You can't let that happen. You've got to be realistic about getting the barriers out of the way that are keeping you from promoting. So when you look at your development program, generic competency development is a fancy way of saying CPE. You're talking about classroom training, online books and videos, college courses, specialty development courses, and this is stuff you already do. The key thing is that you may not be doing enough with respect to the kind of skill training that you need. So, for instance, instead of sending them the tax update every year at the State Society, you need to be looking for leadership development training, maybe looking for soft skill type training, practice development skills. There are a number of national organizations now that offer ongoing partner development programs. I recommend that you look into those. If you need to know who they are, I'd be happy to talk to you about that. You can just send me an email and I can give you a list. But this is something that either add on to the existing CPE that you're already doing, or redirect the CPE towards bridging the gaps in your people's development. Firm-specific development is also known as on-the-job training. And what we're talking about here is making sure that we're giving people increasing levels of assignments so that we're developing them further towards partner, and also testing their skills as a partner. One of the techniques that we see many firms using now, it's a very popular method, is the income partner role. It used to be, I'd say 20 years ago, that income partners was a place where you parked somebody who was never going to be an equity partner. And in fact, for that reason, some firms refused to use the income partner status or non-equity partner status because they didn't want to actually, have people that had hit the ceiling before they got all the way to partner status. But what I'm seeing nowadays is that the ratios are running as high as, in some firms, 40% of their partners will be income partners. The average for firms that are in excess of 25 million is probably around 20% of the partner group is income partners. And this is now being embraced as a development tool. So it gives us a chance to put somebody in the role of a partner. As far as the outside world's concerned, the clients are concerned, and even internally, this person is a partner. They have all the duties, the day-to-day duties of a partner, but we haven't made the financial commitment to them, and they haven't made it to us. So that if they turns out they can't really make the final leap to partner status, it's much easier to unwind the relationship or to stop it at that point. I recommend that if you're going to go down this road, that you think about what the financial implications are. It's nice to have an agreement in place. Some firms actually have retirement plans for their income partners. I'm not necessarily recommending that. But I do think that if you're using it as a development tool, you should probably expect to have a person in that role for maybe no more than 2 or 3 years. And if they can't make it the final development within 3 years, they're probably not somebody that you'd want to consider a partner down the road. More information about how to address emerging leader issues in your firm. I'm a member of the CPA Consultants Alliance, and we've recently presented 2 webinars on these issues. One was the quest to build a learning culture, and the second was making internal communication a must-have. You can download or listen to these webinars on the CPA Consultants Alliance website, and there's a link. Keep in mind you have access to this presentation, so if you want to just go back to it and to this slide to get that link later, you can. But I highly recommend you listen to those webinars. With that, Nikki, I'll turn it back to you for the final polling question.
Okay, this is our third and final polling question. The statement this time is, the retirement provisions in our firm's agreement satisfy our partners and will not create financial hardship for the firm. So as you can see, your choices are yes, definitely, probably not, uncertain, we need a new agreement, or we don't have an agreement. So take a few moments here to decide and to submit your answer. One final reminder that you do need to complete the polls in order to receive the CPE credit. And I'll leave the poll open for another few seconds. Okay, the poll is closed now, and I've shared the results. It looks like the most popular response was we don't have an agreement. That was at 42%. Next was uncertain at 22%. Probably not, 18%. Yes, definitely was 13%. And then we need a new agreement was 4%.
Okay, so those that need a new agreement and those that don't have an agreement, be sure you put our December 3rd webinar on your calendar, which is what are the things that should be included in your partner agreement. So we'll talk more about how to build a partner agreement in that webinar. Okay, so what is the right financial arrangement? Or, in other words, what's the multiple? Show me the money, as Jerry Maguire would say. You know, what is your firm worth in an internal buyout? What's the right way to structure your deal? One of the things I think I need to start off with is to let you know that an internal deal and an external deal are not the same, and they shouldn't be the same. And why is that? You know, why is it that when I go in and I tell a firm, okay, this is what I recommend you do on your internal deal structure, and they say, wait a minute, if I sold my firm on the street, based on what I know, this is what I would expect, and I'd say, yeah, you're right, that's not far off. Why can't I get that on my internal deal? Well, first off, there's some huge differences between an internal deal and an external deal, and these are some of them. The biggest one, I think, is the fact that an internal deal is, in effect, a put option. So what you have is you, as an owner of the firm, are in a position to require, based on this contract that you've all signed, which is called an owner agreement or partner agreement, they're required to buy you out. If you were to have that kind of arrangement in place for a stock that you were selling on the on the stock exchange, you would pay dearly for a put option. That's the way it works. So I own 100 shares of GM stock, and if I have a put option on it, I paid something to have that put option. So in effect, part of the difference between the valuation in an internal deal and an external deal is that put option feature. The second is that there's a lot of risk, there's a lot of cost associated with marketing your firm on an external basis, and therefore that gets factored into the valuation as well, the difference in the valuation. And the third is that our goals aren't the same. In an external deal, we're trying to maximize, probably the only thing that we're really concerned about is maximizing the value of the firm. I mean, the fact is that we're going to sell the firm, we're not going to be the successor firm. But in an internal deal, we have, there's this intangible which says I want my legacy, part of what I'm trying to do here is create an ongoing viable organization. And therefore there's an intangible value that needs to be factored into it as well. So typically your internal deals are not going to be valued as high as an external deal, and that's borne out by what's actually happening in the profession. About 20% of firms do any kind of pre-fund, and less than 10% fund 50% or more, and that comes from these surveys that we have. And why is that? I think this is an interesting thing because I think there's a lot of criticism of the way partnership agreements are built for accounting firms because of a lack of pre-funding. But the reality is that a retirement plan in a partnership agreement is not really a retirement plan. We call it that primarily because of the tax treatment, the way we've structured it in order to make it deductible as paid. But what it really is a transfer of ownership. Well, if we're going to have a pre-funding arrangement, one of two things has to happen. Either the person that's going to be selling their interest is going to be paying for part of their own funding, and in fact, if we're 100% pre-funded, I've paid for all of it. I haven't actually received any value for my ownership interest. And if I'm not going to be paying for it, but I'm going to require my other partners to pay for it on a pre-funded basis, which I've seen some arrangements like that, what's happening is now I'm asking them to take a step back in compensation because they don't have the benefit of using the compensation that I've left behind, and we're going to talk more about that in a second, the compensation that I've left behind to pay for the pre-funding. Now, there are some circumstances I've seen that have worked to some extent where we might have a firm where we have a concentration of equity in one person, say they own 70% of the firm, and they want to diminish that equity to a much lower number while they're still there, and the firm's profitable enough, it's growing enough, and we can actually execute part of the buyout in advance of retirement because we have enough capital to work with within the compensation pool to make that work. And I can see that working sometimes. You know, based on the surveys, again, this is from the PCPS survey. The Rosenberg survey has a little bit skewed more towards the multiple of compensation, but I think that reflects the fact that larger firms, for the most part, respond to that survey. 37% of the firms that respond to the PCPS survey use a multiple of equity, which means that if I own 50%, or say I own 33% of the firm, that we come to some kind of theoretical value or some kind of formula-based value for the overall firm. We apply my equity percentage to that, and that determines my value. So if we decide the firm's worth $2 million because we have $2 million in volume, then my 1/3 is worth, you know, $667,000. 16% use a managed book of business approach, meaning each of us has our own managed book of business, and that's what determines my value in the firm. 22% use a multiple of compensation. Oftentimes that's going to run between 2.5 and 3 times some average compensation over a 3 to 5 year period, paid over, say, 10 years. So if I'm making $300,000 and we use a 3 times compensation, that would be 3 times $300,000 is $900,000, which turns out to be $90,000 per year. And then 25% use some other approach. Of those that use the equity method, which is the most popular, less than 10% had a value in excess of 100%. About 40% use 100%, which is still the most popular method, but actually less than a majority. And 30% use between 75% and 100%. The trend is definitely down. We're seeing in the larger firms that still use equity methods, the valuations as low as, you know, I've seen them as low as 65%, 60%. Most of those firms are going to be between 65 and 80% nowadays. For those that are using compensation, which is the second most popular method, about 40% use 3 times. That's actually a proxy for 1 times revenue when you think about it. About 15% use 2.5 times, and between 15 and 20 use 2 times. And again, the trend is downward. I'm seeing a lot more 2.5 times compensation approaches than I'm seeing 3 times nowadays. You know, what you want to do is make sure that you tie the payout in the plan to a proper transition. So for instance, going back to our suggestion of a 2-year transition plan, you know, tying the payout of the partner retirement to having given 2 years notice in advance, and if you don't, there's some penalty for doing that. Some firms specifically will reduce the valuation by a specific amount. Say instead of paying 1 time, we might pay 80% or 75%. We think a better approach is to make the payout contingent on some post-retirement activity, either, you know, potential loss of business in the overall firm or a potential loss of business in a managed book of business. But making sure you somehow tie the transition plan into the agreement, again, through that notice period, and trusting that the transition plan will work. So, you know, in the one case, what we're saying is, you know, we want to make sure that the plan will in fact be executed, and in the second case, we want to make sure that the plan, the transition plan will actually work. The clients will actually make the transition. You know, when you can't take that chance is when you have a specialty book of business. Let's say you, for instance, have a partner that's a litigation support partner, it's going to be very difficult to transition those relationships. You know, it may not be appropriate to have a fixed obligation at the date of retirement in that case. Or you maybe have a client that's extremely large. Partner manages $1 million book of business, but he has a $500,000 client. You know, there's just too much risk associated with that relationship, and maybe we put the $500,000 client on a contingent buyout, whereas the rest of the business might be a fixed obligation at the date of retirement. Okay. You know, looking at the right financial arrangement, we take what we call a backwards valuation approach to this. The backwards valuation says we're going to reward our retiring partners for all the years of sweat equity that they've built up fairly, but we're not going to expect any partner that's remaining to take a step back in compensation in order to buy out a retiring partner. You know, buyers in external deals don't accept negative cash flow either, so for very long. I mean, there might be a year or maybe 2 years of potentially of negative cash flow building back up working capital or something. But for the most part, they're not going to take negative cash flow as in any kind of valuation either. So how do we do this? Well, the available capital that we have for the buyout is the retired partner's foregone compensation. And we're going to use that for 3 different things. We're going to use that for the retirement payments. We're going to use it to replace that partner's duties, and we're going to use it to create some upside for the remaining partners because they'll be taking on, you know, additional obligation and potentially more work. We also want to create an incentive for them to do this. So as an example, we have a retiring partner whose comp and benefits is $300,000. We decide that replacement resources are about $120,000. Now what I mean by that is we're not talking about replacing them with another partner. We're talking about replacing their productive capacity. So for instance, if they're producing $300,000 of billable time, we might be able to buy that time through staff time for about $120,000. That leaves us with $180,000 of remaining capital, and now we need to decide how much, how much of that $180,000 we can use for the buyout, and how much we should have left over for the remaining partners. So let's go through a specific example. Say we've got a firm that's a $1.9 million firm. The partner retiring is a 45% partner. We're using an equity method. We're going to pay out that retirement over 5 years, which 45% times 1.9 is, of course, let's see, that's $855,000. And he's got a capital account, $175,000, which we're going to pay out in 1 year. And we've decided that the cost of replacing this partner is $125,000. So how does that work out? Well, it doesn't work out very well. In the first year, we're going to spend $175,000 buying out the capital account right up front. We're going to spend $171,000 in retirement payments, meaning we're going to create $146,000 of negative cash flow. Remember, we had a $275,000 comp, less $125,000 for replacement, so we had $150,000 to work with. So for the first year, all the rest of the partners are either going to borrow $146,000 or they're going to take that much step back in compensation. And then for the years 2 through 5 to complete the buyout, it's a $21,000 negative cash flow. Not a very compelling agreement. An alternative plan would be to pay the capital over 5 years, pay the retirement over 10 years, but not reduce any of the actual obligation. So in that case, we've got $150,000 of available capital. We've now we're paying $35,000 a year for the capital account, paying $85,000 a year for the retirement. We have almost $30,000 of positive cash flow in the first 5 years, and about $65,000 of positive cash flow in the next year. The retiring partner hasn't left any money on the table. The other partners can still afford to pay for it, and nobody's taking a step back in compensation. When looking at your transition needs, the things you want to take into account, make sure you're requiring adequate notice so that you have enough time to go through the transition. Make sure you tie that notice and the execution of it to the owner agreement. Identify a successor for all your duties in this, and make sure you make clear assignments of those duties. And then take into account the fact that you're potentially going to have double comp. If you have a performance-based system where partners are paid for what they produce, for the hours they produce, for the managed book of business they manage, and so forth, you're going to have people sharing duties during that transition period. You may need to break away from that, that formula-based approach with respect to the retired partner. And you may have to decide, you know what, somebody's going to be making less money than they would have made under our formula system while they assume these duties, while somebody is making more money than they would under our formula system while they relinquish these duties. But it's for the good of the firm long term for us to go through that. So don't let your partner compensation system get in the way of the good execution of a transition plan. And with that, I will turn it back to Nikki to finish us off.
Great, thanks, Terry. So as I mentioned earlier, you'll receive an email from me that'll have a link to the evaluation that you'll complete, and then I'll be sending out the CPE certificates within the next week. As Terry mentioned earlier, we will have a video. We've been recording this webinar, and that'll be posted to our website by Monday at the latest. You'll receive an additional follow-up email from Terry, and that'll have a link to that, and you can always contact me if you have any questions. And then finally, I just want to remind you that before you close your browser, please pause for just a moment. There's a very brief survey. It'll give you a chance to request a copy of today's slides if you didn't get them already, and then also just provide some brief feedback suggestions for future topics for us. So with that said, I thank everyone so much for attending. We appreciate it and hope you have a good afternoon.